We're going to stay with the impact coronavirus is having on equities and bonds. Our next guest says that this is the definition of a black swan event, and that instead of adjusting your portfolios, it's really a buying opportunity for both intermediate and long-term investors. But what should you invest in and when? MV financial investment strategist Arian Vojdani joins us now with more on this. And what warning would you have for those of us who don't have your expertise if we're looking at bonds, especially, I realize you're high grade value, but there's a real concern about leveraged loans and some of the lower grade corporates out there. So what advice do you have?
I would stay completely away from any of that. I've said this before when I come on. Short-term, high-quality debt is where you want to be if you're scared of what's happening in the market. And it's safe to say you should be a little bit afraid of what's happening. I think there's a lot of uncertainty out there in the market. We've never seen a black swan event of this nature, pandemic of this kind. So I think pain is ahead of the game for us. Regardless of what the Fed does, I think we're going to see the markets continue to draw down for quite a while. I mean, this is a relief rally right now, so you have some opportunity, but if you're not really ahead of the game at this point, adjusting your portfolio is not the right thing to do at this point, and you're not going to really make any changes to your portfolio that will really help you at this point.
Do you think the Fed is going to cut by 50 basis points? And you just said you don't think it's really going to help in this situation. Why not?
I think I think monetary and fiscal policy at this point really, we're going to have to see how this whole thing plays out, right? We know that it might help in the immediate term, give us a sugar high short term. What happens when the markets, which the worry here is that this pandemic is going to slow down global growth. Europe on the verge of recession, Japan really close and probably going to go into recession. Given this, if that happens here, we have more runway. What happens when the whole world really slows down and central banks have nothing left in their toolbook to help us out of it because we're so preemptively cutting back and we're so low for so long? That's a question that managers like myself don't have the answer to, and I don't think anyone has the answer to. I think we need to get this contagion under control and allow the world to get back to what it does, and supply lines, manufacturing, get that all back in line, and then we can look at how the Fed will help us.
Is this just a poorly timed outbreak in terms of where where the markets were going before, where the economies were going before, and this just sort of was a catalyst? Yeah,
that's a great question. It is poorly timed, but I said this last year, we had started cutting back our portfolios equity-wise and risk-on-wise March of last year. So the markets recovered from 2018. Everyone was kind of coming off from that. We said this is a good time to take money off the table. We knew we'd miss out on 2019 growth. That was a great year, obviously. But we were happy to take money off, reduce emerging market allocations, reduce international allocations because we thought those parts of the world were slowing down. So, yeah, if you haven't already done that, you're late to the game. And did this happen at a bad time? Sure, but I would say you should have been expecting the world was slowing down already and ahead of time.
So you say that now might not be the best time to adjust your portfolio, but I know a lot of people now, even some who have never done anything with stocks, are looking at this as potentially an opportunity to get in. They've seen the growth over the past few years, and they see that now everything's a little bit lower. They may be able to jump in. When should they do that?
I think any time you buy on the U-curve down is a better time than before. So you could be, right now if you're trying to time it, it's always impossible to time it. As long as you're buying somewhere on that downslope, it's a better time to buy. So hard to say. If you have some cash and you're ready to deploy it, I say go for it.
But you got to be ready for a little bit more down before the up, maybe.
It's going to be a longer term play, not so much a short term
Real
play.
quick, you willing to take any more short term debt, especially with the Fed about to drop rates?
That's really the short term debt is really a play to mitigate equity risk and also to have buying opportunity. If you have short-term floating rate bonds, things of that nature, it allows you to sell because they're highly liquid and get into the equity market when that becomes more attractive. I think I'm happy sitting where I am now, and I'm not going to really change anything like I said before at this point.
All right. Arian Vojdani, MV Financial Investment Strategist, thank you for being here on The Move.
Great to be on, thanks.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.